The response to this crisis has been twofold. On the one hand, governments have been spending more, and in the case of the US, actually writing checks for their citizens. On the other hand, central banks have been printing money. They've massively increased the size of their balance sheets, and they've got huge asset purchase programs. Now, many people are concerned, perhaps justifiably, that this is going to create a very high rate of inflation. Or it could be that the massive reduction in demand from the lockdowns creates deflation. So if you want to keep track of this and other macroeconomic variables through this crisis, then why not sign up to our free weekly market roundup? But now let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start off by looking at what we mean by inflation. Let's say that we want to buy a loaf of bread. If we look at almost any price over a long period of time, what we see is that it generally increases. So since the 1980s, the price of bread has almost quadrupled in the United States. When we look at inflation, we usually think in terms of annual changes. So here's the annual change in the price of bread over that time period. And you can see that most of the time it's positive because the price is increasing, but sometimes the price change is negative, and that's deflation. Here's the same thing for the UK, looking at the price of an 800-gram loaf of bread. The typical annual price increase is about 4%. Now, food items tend to be quite volatile, which is to say that the rate of inflation fluctuates a great deal. So these are sometimes stripped out of the inflation statistics that people look at. Instead of looking at just one price, the job of a statistics agency in a country, whose role it is to calculate inflation, looks at regular surveys of thousands of prices. And they also have to produce a representative sample of a typical consumer's consumption. And this is called the consumption basket. This is a breakdown in 2020 of a typical US consumer's consumption basket, as defined by CPI-U, which is for urban consumers. If we look at the broad categories, you can see that food's about 14% of the consumption basket, energy is about 6.7%, and so on down the consumption basket list. You can see that shelter, which is where you live, is a big part of that consumption basket, because rent or mortgages tend to be a rather large proportion of your outgoings. The consumption basket in the UK is similar to the US, dominated by housing and household services. If we look at emerging markets, one of the significant differences is that food and beverages constitute a much bigger proportion of the basket, in this case almost half of expenditure. And as tastes and our pattern of consumption changes over time, so too does the basket. So for example, in the UK recently, there's been a move to gluten-free and vegan foods. So gluten-free and vegan cereals have been added to the consumption basket. So has a cocktail in a can, in this case gin and tonic, and a personal favourite, which is veg crisps, which contain parsnip, beetroot and carrot instead of the regular potato. Now let's look at the typical drivers of inflation. During periods of strong economic growth or an economic boom, this often comes with a rapid increase in wages. And as people have more money to spend, that increases demand for goods and services, and that in turn pushes up prices. And this is called demand pull inflation. When a company creates goods and services, it has costs that it has to pay. Those are its input prices. That might be the cost of labour, the cost of capital, or it could be something like a commodity price, like the price of oil. Now, to some extent, the company can absorb those costs, but if it has pricing power, then it can increase the price of its products and services. And that's called cost push inflation. When a country has to import goods and services, then when its currency depreciates or loses value relative to its trading partners, the effect is to increase the cost of those imports in its local currency, and that's called pass-through inflation. During periods of low unemployment, employees are much harder to replace. That means they have a much stronger negotiating position when it comes to wage increases. So during periods of very low unemployment, we might expect to see wage push inflation, as salaries increase and companies raise the price of their goods and services. And finally, what we're focusing on at the moment is a rapid expansion of money and credit. This is usually done by central banks to counteract a crisis. And the concern which many people have is that this will fuel demand-pull inflation by overstimulating the economy. So for example, when the Fed floods the US with dollars, but the level of goods and services remains the same, then one might expect that the price of those goods and services would increase, because there are more dollars chasing the same amount of goods and services. Looking at the US Central Bank, the Federal Reserve, we can monitor the size of its balance sheet over time. And during the global financial crisis, there were several rounds of quantitative easing, in which the central bank bought US Treasuries, but also a lot of mortgage-backed securities. There were several rounds of QE, then the size of the balance sheet was fairly stable at about $4.5 trillion, and then the Fed started to run off the size of the balance sheet. During this crisis, the Fed has announced many extremely large bailout programs, and very rapidly, its balance sheet has shot up to over $6 trillion. And it's probably going to go up significantly higher. The thing to remember is that the Fed only makes loans. It doesn't make grants. Only the government can give money away to its citizens. So at some point, these loans will be repaid to the Fed and its balance sheet will shrink again, just as it started to do in 2018. Now, many analysts, but also many hedge funds, thought that this huge stimulus program and money printing by the Fed would stimulate a huge bout of inflation. That never happened. In fact, the Fed was struggling to keep inflation at its 2% target. An increase in the money supply will only create inflation if the velocity of money remains constant. What is the velocity of money, you may wonder? It's the number of times a single dollar is used to buy goods and services per unit of time. You can also think of that as how many transactions are occurring between individuals in an economy. If we define money as the amount of currency in circulation, and that's called M1, you can see what happened after the global financial crisis, which is that the velocity of money decreased dramatically. Or in other words, there were simply less transactions. And that's one of the reasons why the Fed's balance sheet, although it expanded hugely, failed to create a huge amount of inflation. We see a similar pattern in the velocity of money if we expand our definition of money to include savings deposits, certificates of deposit, and money market deposits. However you look at it, the velocity of money decreased dramatically. Janet Yellen, who was a previous Federal Reserve chair, thought that the reason why there was no inflation was because there was a great deal of slack in the labour market. And that was one of the justifications she had for keeping the size of the Fed's balance sheet very large, in what the central bank would call extraordinary accommodation. Now, one measure of slack in the labour market is how unemployment compares with NAIRU, which some people call the natural rate of unemployment, but which is defined as the non-accelerating inflation rate of unemployment, which is the unemployment rate which has a neutral effect on inflation. So during one of these points in time, when unemployment is exactly equal to NAIRU, in theory, at that time, inflation should remain constant. Whereas when unemployment dips below NAIRU, that's inflationary. And if unemployment is above NAIRU, as it was after the global financial crisis, that should have been disinflationary. It should have pushed inflation downwards. One difficulty with this measure is that nobody can agree on NAIRU. If you ask two economists, you'll probably end up with three opinions. And this estimate is produced by the US CBO, which is the Congressional Budget Office. Now, this explanation doesn't really hold water because you can see this period during which unemployment was well below NAIRU, and yet we didn't see huge inflation in the United States. Another explanation as to why the expansion of money supply didn't generate inflation is something called the liquidity trap. Now, in theory, that money should have been used to buy goods and services and stimulate the economy. But if instead investors were hoarding the increased money supply instead of spending it, then the velocity of money would fall dramatically and we wouldn't get inflation. And by setting interest rates to zero, the cost of holding cash becomes negligible, because you're not going to get much better rates of interest by buying long-term interest-bearing assets, such as government bonds. So if we do get hoarding of cash by banks, but also by individuals and investors, then we could fall into this liquidity trap. And even though the Fed's expanded its balance sheet massively, we may not get huge inflation. So whose job is it to ensure that inflation doesn't get out of control? Well, of course, that's the central banks. This is from a web page from the Bank of England, where they explain that their inflation target is 2%. And just like the porridge in Goldilocks, you don't want it to be too high or too low. Central banks judge that 2% is just right. And the target for the Federal Reserve is also 2%. And they think that's consistent with their mandate for price stability, but also their mandate to ensure maximum employment. Stable prices means that people can plan borrowing, lending, saving, and investment. And it also ensures that longer-term interest rates, which are dominated by inflation, don't rise too high. And the inflation target for the European Central Bank, the ECB, is, you've probably guessed it, below but close to 2% over the medium term. Now, the value of stocks depends very much on the level of inflation, and it's no accident that when inflation is at around 2%, which is this part of the graph on the x-axis, that's when equity valuations tend to be highest. So the valuation here, I've used Shiller's CAPE measure, and this is for the US S&P 500. If inflation gets too high, so here we're at around 4 or 5%, then the valuations start to fall quite sharply. And if we get deflation, which is negative inflation, again, equities derate. The price to earnings multiple falls. So while equity does provide some protection if inflation moves away from that 2% target, once it becomes too extreme, either on the upside or on the downside, equity derates, and that protection disappears. How about if inflation gets completely out of control and starts to rise at an incredibly high rate? Well, that's called hyperinflation. The causes for it vary from country to country, but usually it's a combination of one or more of these factors. It usually strikes economies which are weak, so growth is poor, perhaps there's been some kind of macroeconomic shock or a war. The government usually has a large debt to GDP ratio, which means that the amount it's borrowed is too large relative to its income, and the Treasury usually gets carried away with printing too much money. So looking at the example of Zimbabwe, you can see that the exchange rate compared with the US dollar got to crazy levels, and this was around the year 2008. So at this point, there were more than a quadrillion Zimbabwean dollars to each US dollar, and it almost reached a quintillion, which is 10 to the power 18 Zimbabwean dollars to every US dollar. So there was a huge currency depreciation. And in 2005, for example, Zimbabwe printed 21 trillion Zimbabwean dollars to repay their IMF debt. And their debt was considerably more than their GDP. And as their money supplies spiraled out of control, so too did their inflation. There was also an episode of hyperinflation in Germany just after World War I, which had weakened the German economy, and they had to pay very large amounts of reparations to European countries. Their debt to GDP ratio was again high, and in order to pay their passive resistance strikers, instead of raising money through taxation, the government decided simply to print more money. And as you can imagine, the result was hyperinflation, but also a huge devaluation of the German mark versus other currencies. And although at the time people were quite willing to blame external forces for the devaluation of their currency, this newspaper article in 1921 admits that they exploited their currency for the purpose of obtaining money for the Treasury by creating a fictitious increase of their total income. This table is taken from the book This Time is Different, 8 Centuries of Financial Folly by Reinhardt and Rogoff. And you can see that the German rate of inflation in 1923 was over 22 billion%. But more recently, in Argentina in 1989 and in Brazil in 1987 and 1990, we've also seen episodes of hyperinflation, with similar economic problems to the examples we've just seen. Hyperinflation is a sign of an economy in serious trouble, but if you're a borrower, it means the principal of your loan is deflated away. So if you have a fixed amount of mortgage or a fixed amount of loan, that very quickly becomes worthless when inflation reaches crazy levels. The only protection against hyperinflation would be something like an inflation-linked government bond, but questions might arise as to whether the government could afford to service that debt, given the perilous state of the economy. Now, gold's a lousy inflation hedge, but in really extreme cases like hyperinflation, gold does retain its value. However, if you're a saver, then the value of your cash or a cash deposit at a bank will rapidly fall to zero value. And if you're a lender, the value of your loan will also fall away to zero. If you buy government debt which is not linked to the level of inflation, so that's a normal government bond, and that's called a nominal government bond, the value of that too will also collapse to zero. And as we've seen, equities also could derate. And that's because the price-earnings multiple would fall, but also because the input costs to the company would increase dramatically, and it may not be able to pass on those costs to its customers. Although it may sound like a good idea, negative inflation, when the purchasing power of money increases over time, is also damaging to the economy. Here's the level of inflation in the United States since 2000, and you can see it's fairly well behaved. It's usually in this band between 2% and 4%, because the Fed has done a very good job. There was a brief period of deflation during the recession following 2008, and a very brief episode in 2015, but generally, inflation was fairly close to that 2% target. If we extend our time period, however, you can see that the level of inflation has been much more chaotic. During the Volcker period in the 1970s and early 80s, inflation reached very high levels of more than 10% and peaked at around 15%. And during the Great Depression, there were extended periods of deflation. And if we look even further back, before 1920, so this is between 1870 and 1920, you can see that inflation was just completely out of control, with huge swings between large inflation and large deflation. So if you do hear people criticizing central banks, just remember that they're on your side, and they're doing their utmost to protect you from these wild swings in the price of goods and services. Now, what's particularly harmful about deflation is something called a deflationary spiral. You can start the spiral at any point, but let's start with rising unemployment. This could be the result of a macroeconomic shock, such as the one we're just seeing, and that results in large-scale layoffs and cuts in wages. If people have greater job uncertainty and a lower income, then there'll be lower demand for the goods and services provided by companies. The lower demand means that there's oversupply, and that means that prices fall. Companies then suffer from decreased revenue because demand is lower and prices are lower, and that means lower corporate profits. And if corporate profits are down, companies, particularly the ones with too much leverage or borrowing, will suffer a higher default rate. So the rate of bankruptcies and defaults will increase. And then the cycle is complete because bankruptcies create greater unemployment. Another problem is that if people see prices falling, they may defer consumption. If a car costs less this month than it did the previous month, then why buy now? Because you know that in a month's time it could be even cheaper. And that deferred consumption reduces demand further. Now, when deflation occurs, the purchasing power of cash, in terms of the goods and services it can buy, increases. So cash and cash-like investments become more valuable. That's good for lenders because the principal is also gaining in purchasing power. And if you own a nominal government bond, that's also good for you. However, if you own corporate bonds, one potential concern is that default rates are greater. So particularly for speculative credit or junk bonds, that could be problematic. If you're a borrower, in other words, you've taken out a loan or you've issued a bond, deflation can become a problem because it's more difficult to service your debt. And some inflation-linked bonds, such as those in the UK, don't have an inflation floor, which means that the nominal value of the bond could fall below its par value. And as we've seen, shares also derate during periods of deflation, but they'll also suffer from a fall in revenue. So what variables can we watch in order to monitor inflation to see whether we are getting hyperinflation or potentially deflation? If you type in this URL, it should generate this graph, which updates on a monthly basis. This is a forecasting model from the Fed, which breaks price pressures into 4 bands. The probability of deflation is shown in purple. Green is the probability of low inflation, red is the probability of medium inflation, and blue is the probability of high inflation. So during the financial crisis, the probability of deflation increased significantly. And in the early 1990s, the probability of very high inflation was significant. At the beginning of 2020, the most likely outcome was inflation between 1.5 and 2.5%. Now this graph is free to access, so it's a handy one to monitor. If you're a nerd like me, you'll find this model description exciting. If you're not, just look away for 10 seconds. But the model which is behind those pretty colours considers 9 factors out of 104 data series grouped in the following way. So it's a very sophisticated model which is actively looked at by the Fed. So it's definitely worth you looking at it as well. Now, whenever the central banks publish their monetary policy, they're at pains to explain it as clearly as possible. The Bank of England used to produce an inflation report every 6 months, but now that's been rolled up into their Monetary Policy report, which is published quarterly. The next one's due out in May 2020. And in that report, they produce this fan chart, which is their forecast for inflation over the 2 or 3 years ahead. What they consider to be the most likely outcome for inflation is in this central red band. It's also possible but less likely when we go to the outer bands. So in January 2020, they thought it was very likely that inflation would be around 2%, which is funnily enough their target, in 2023. And again, this is completely free to access. Of course, nobody believes forecasts, but they're useful as a frame of reference. So in the UK, the Office for Budget Responsibility forecasts what's going to happen to the UK economy, just like the Bank of England. And part of their recent forecast looks at inflation. But as they point out, that's a very difficult forecast to make because some markets are going to have excess supply. So for example, during a shutdown, not many people are going to go out and buy trucks, whereas other markets could be in a state of excess demand. And an example of that would be toilet paper, which for some reason has become irresistible during the shutdown. They go on to say that there's going to be downward pressure on some prices and upward pressure on others, but they're not sure which factor is going to dominate. So instead of trying, they're just going to ignore the pressure of demand on inflation, which is a forecasting equivalent of shrugging their shoulders. They do say that there might be pass-through inflation because the value of sterling fell very dramatically in March, by 12% over the course of just over a week. It did recover, but it's likely to be volatile through this period. The price of oil has also fallen dramatically. That's likely to reduce the cost of living, because energy is part of that CPI index. However, the OBR expects that next year, oil prices will bounce back. A more sophisticated model comes from the National Institute of Economic and Social Research here in the UK, and their expectation is that this macroeconomic shock is going to lower inflation. But just like the OBR, they say that these two forces of reduction in demand and reduction in supply are pulling in opposite directions. In some countries, such as South Korea and the UK, they expect the reduction in demand to fall short of the reduction in supply, and that will temporarily create an upward pressure on prices. In other words, it'll generate inflation. But those two countries are the exception. More generally, they expect lower inflation. However, the impact's going to be offset because central banks will adjust their policy. The European Central Bank is in a bit of a pickle because it's got negative interest rates already, and this lower bound means they have less scope than other economies to cut rates further. They may have to adopt alternative extraordinary measures, such as the asset purchases which the Fed is currently undertaking. Here's their forecast for the effect on inflation compared to their base forecast without this shock. So South Korea and the UK in year 1, which is in black, are expected to have slightly higher inflation, which diminishes in year 2, and the long-term impact, which is in grey, is negligible. Whereas Italy has a very large disinflationary shock, which means inflation is going to be lower because the reduction in demand will be greater than the reduction in supply, with a similar pattern in China, but the magnitude of the impact there will be smaller. And you can see that the effect on the US is forecast to be fairly negligible. So for now, it looks like inflation probably won't be the primary impact of this crisis. Growth is going to be a much bigger concern, and that's going to affect corporate revenues, and it may create a problem with credit. That's probably going to be more of a problem than inflation, at least in the early stages of the aftermath. So if you want to keep abreast of this, why not join our community? It costs just $10 a month, and you get to join us on the chat application Slack. And then you can ask a question whenever you like online. And you can also join us on our Sunday evening calls. And we've got an example of that, which we posted as a live stream on YouTube, which you can see anytime you like. So as always, thank you for listening.